Hey, good afternoon, everybody. It's 3:33 p.m. over here. Markets just closed about a few hours ago, and it's looking, it's a mixed bag. I mean, overall, it looks pretty good. There are a few weak points that I want to discuss. At the same time, the market can keep going higher, so I want to review both sides and kind of take a look at what the S&P has been doing. We can go over the fundamentals, we can go over the technicals, and we'll take it from there. If you like the video, feel free to give it a thumbs up, or if you don't like it, feel free to give it a thumbs down. Feel free to subscribe. I'll be doing these videos on a regular basis, and let's get straight into it. So first, let's dive into the fundamentals. Let's dive into the news of this week. Okay, so the main talking points were on Wednesday, Thursday, as well as today. We had inflation data come out. We had core inflation data, and we had the regular inflation rate. Core inflation just excludes volatile food and energy prices. So you know how the price of eggs in some areas have been skyrocketing, avocados or gasoline, right? Core inflation excludes those. The regular inflation rate does include those. However, what's more important are these numbers right here. Actual versus the consensus. So before the data came out, everyone was agreeing that the core inflation rate would increase 0.3% month over month. Well, that wasn't the case. We actually increased 0.4%. And same thing, right? We thought it was going to increase 3.1% year over year. Well, we actually increased 3.3%. The regular inflation rates, again, 0.3% and 2.9 converted over to 0.5 and 3. So if I click on inflation rate year over year right here, we can get a little bit of a summary. The annual inflation rate in the US edged up to 3% in January 2025 compared to 2.9% in December 2024. This was above market forecast, as we just noted, and this indicates stalled progress in curbing inflation. Not good. We also had the producer price inflation rate come out month over month. This is just the inflation rate for producers in the US, right? When they're making their goods for businesses, the factories, right? They're ordering their goods, and inflation has caused these goods to increase. The consensus was 0.3%, and the actual numbers came in at 0.4%. So everybody agreed that they were going to come in at 0.3% rise, but they actually came in at 0.4%. This signals an increase in inflation. It came down a little bit compared to December, so it's not as hot, but it came in hotter than expected, according to the consensus. We also had retail sales month over month as well. This was actually terrible. The retail sales came in, and retail sales in the US contracted 0.9% month over month in January. Much worse than forecast of a 0.1% drop. Okay, so everybody was expecting this to contract about 0.1%. Following the 0.7% gain in December, retail sales actually increased in December, right? Christmas and everything. But retail sales contracted in January. This was partly because of the LA fires and severe weather, as noted right here. They weighed on consumer spending, right? And it's just not ideal, right? We all know the LA fires, they were going to have some sort of implications, and it looks like we're starting to see that, right? LA is a huge economic hub for consumers, goods, businesses, and all of it just got burned to the ground, which is absolutely devastating. So inflation is here. Inflation is rising compared to all these reports, and it doesn't look good. So now, since those reports don't look good, we might be asking ourselves, okay, then why was the market rising this week, right? Why was the market doing pretty good? We were testing all-time highs. We actually made an all-time high on the SPY. So what's going on here? Well, this is probably the more positive news for the meantime, according to the Wall Street Journal. So we all know about Trump's tariffs. We all know how Trump was, he was threatening tariffs at different countries, and just overall almost created a multi-globe trade war, right? Or so it seems. Trump orders federal agencies to study reciprocal tariffs. This article is from the Wall Street Journal right here. And let's dive into what Trump had to say first.
Decided for purposes of fairness that I will charge a reciprocal tariff, meaning whatever countries charge the United States of America, we will charge them, no more, no less. In other words, they charge us a tax or tariff, and we charge them the exact same tax or tariff.
Okay, so why is this good news? Well, large U.S. companies breathed a sigh of relief on Thursday that tariffs weren't immediately imposed, and this expressed hope that Trump would use his reciprocal tariffs to plan to negotiate lower duties with trading partners rather than spiraling into a multi-front trade war, right? Rather than saying tariff here, tariff there, tariff there, he's saying that with the tariffs that are imposed on the U.S., or if anyone does impose tariffs, we're going to reciprocate that as well. So, it's a relief that the administration isn't rushing to impose new tariffs. There's a different nuanced approach going on here. Ideally, this process will result in us working with our trading partners to lower their tariffs and trade barriers as opposed to increasing our own, right? So this actually could be very, very beneficial for the markets. Why? Because of right here. It isn't certain which countries would be the most affected by potential American reciprocal trade actions, but many of the nations with the highest tariff rates on U.S. goods are countries like India, Brazil, and Vietnam, Argentina, and some Southeast Asian and African nations. So if they have tariffs on our U.S. goods right now, which means that their businesses are going to have to pay more for our goods to enter their countries, which means that they may or may not want to pay for our goods entering our countries. If they have those tariffs implemented, then we will also meet them with their own tariffs, with our own tariffs on their goods, right? That's all Trump is doing. So if countries don't like this, they could remove their tariffs, and that could actually increase global trade. That's a good sign. That's a positive sign. However, Trump did acknowledge that imposing tariffs might raise consumer prices in the short term, but said it would be worth it in the long run. So, therefore, Trump's move on reciprocal trade could mean that his campaign pledge for across-the-board tariffs is less likely. Trump said that he was leaning more toward reciprocal action rather than a flat fee tariff, like what he was threatening beforehand. The White House also signaled Thursday that the flat fee option isn't off the table, so there still can be surprises. Okay, so with all that inflation data on the table and Trump's implementation of reciprocal tariffs, let's dive into the technicals and what is the price of the market showing us? What does this actually mean for the market? A few things I want to consider on the SPY chart here. Today on SPY, we made an all-time high of 610.99, although it's not super convincing considering we have this very, very small little red candle right here. What is convincing is this small trend line right here, and we have a little bit of a breakout. Okay, if you can see, we have 1, 2, 3 touches right here along this trend line, and we break out with a nice big green candle with somewhat steady volume, somewhat increased volume. It's not bad. The past 2 days have been really, really good for the market. So therefore, ideally, we want to kind of stay above in this general region up here, right? Maybe we pull back a little bit, maybe we increase to see the markets continue to have an ensuing uptrend. We do not want to see this big trend line broken right here. This is the one that I've drawn. This big trend line right here is the one that I'm really, really, really watching, right? You can see we have 1, 2, and 3 touches here. This is our current uptrend. If we go below this uptrend, if we go below this trend line, that's not going to be ideal. We can also put on our 50-day moving average, which will be this blue line where we have right here, which will be the blue line right here. And if we go below the 50-day moving average, it's also in alignment with the trend line. So therefore, I can draw the conclusion that we do not want to see SPY move below the 50 moving average. That will be a bad, bad sign. We do not want to see that. Can there still be surprises in the market? Inflation data doesn't really look too well. I'm not bearish, but I'm just saying, hey, this is the other side of the equation. I'll get into the bulls in just a minute. We also have this gap down here, which again, I just don't like. It just doesn't sit well with me, just seeing that gap there, because SPY likes to fill gaps. And you never know what can potentially happen, what's out there. Also, the uptrend isn't super convincing yet, considering that we did make this high around 610.78 here on January 24th. And again, like we've come up to it once, twice, and then a third time, and then we're met with a red candlestick right here. It's like, okay, are we breaking out and are we going to continue upwards, or is this going to act as a resistance? No matter what opinions anybody has about the markets, the fact is clear. We haven't been able to get out of this 610 area. We haven't been able to push out of this 610 area. We started traversing in this supply zone, right? We can call this supply because every single time that the market comes up here, there is not enough demand in the stock price. There are not enough buyers to push the price higher. So this is all supply. This is a supply region right here. What we need to see is the market move higher, which it can. Let's get into that right now. So what can constitute the market moving higher? Well, these are some of our levels right here with extensions. The way I'm going to draw these is point A, point B, and point C, also known as low, high, and higher low. So let's go ahead and draw these and see what they give us. 1, 2, and 3. Wonderful. Okay, so let's get rid of these drawings just to make it a little bit easier to read. 61.8% level currently is being respected right here, 609.41. You want to see the price above the 50%, and we want to see the price above the 61.8% because these are our reversal levels. Ideally, if the price did come up in this region and we did end up reversing, that's not a good sign, but we did see it move above the 61.8% level. So we do want to see this level being held right here as a support area. If I go to the 4-hour chart, we can see that the market is currently respecting it. So our levels are accurate, right? 1, 2, and 3, and we are touching it right now in pre-market. Not to say that we can't go lower, we absolutely can, but at the same time, if the market decides to move higher, the next incoming levels, we have $612.38, and right after $612.38, we can see $616.15. So these are good signs for the bulls of the levels that we can potentially see if this is a good breakout right here. We can see a closer view of this breakout here on the SPY chart. Okay, again, the trend line 1, 2, 3 touches, and we have our breakout. And we have our breakout right here with these nice big firm green candles, and we have increased volume, right? We can see that right there. So that looks really, really good. Let's dive into another ticker that I want to show you. QQQ, the Nasdaq-100 ETF. Now, some of you may already be aware, but we did have some sort of cup and handle pattern going on right here. I'll remove the 15-day moving average, so it's a little easier to see. We have the cup right here. This is where the trough of the cup comes in. It's a little deep. It's not a V shape, which is good. It's more of a U shaped, and that's exactly what you want to see. That is a bullish signal, and then we see our handle form up right here. Right? This is a bullish continuation pattern that, if accurate and if legitimate, we can see further upside. 539.15 is our current breakout price. We need to move higher than this price of 539.15 if we want to see continued upside. We have 3 nice green candlesticks right here, which look pretty good, right? Look at that. And if we look at the volume, it's not bad. We have increased volume moving upwards a little bit, which is generally good. We want to see that. It's more of a positive sign. Again, what I don't like is how we just come back up into 539.15 today. We did not make any new highs on QQQ today. If I go to the 4-hour chart, we are right below this level, right? And will there be enough momentum to sustain a continued uptrend? I am not sure. I'm hoping there will be, right? Because everybody wants to see a bull market. Well, at least I think most people do. But again, just stay solvent because we are at this resistance here, 539.15. This is going to be a confirmation level. We do want to see it move higher than that. We do have this trend line that is giving us support. So this is what I call the neckline of the cup and handle pattern, right? Accurate trend lines. We have 1, 2, and 3 touches all surrounding, or excuse me, all along this trend line right here. So this is our neckline. This is exactly what you want to see. So the cup and handle pattern is currently working, and it's great to see the market move higher because of the potential positive news of Trump just doing reciprocal tariffs. Now, I wouldn't say that's necessarily positive news. It's just better news than the tariff implementation plan that he had beforehand. So can tariffs still happen? Absolutely. So just be solvent. Again, we have that gap on the SPY that we were talking about earlier, which is down here. Again, I just don't like that. It just gives me the possibility that the SPY can definitely see these levels again sometime in the future. We don't have to. The market doesn't have to give us anything. The market does not need to fill any gaps. I just think that a common characteristic of the S&P 500 is to fill those gaps at some point in time. But of course, you can always go back and check them out yourself. There have been some gaps that we have never filled before, so anything can happen. Going back to the S&P 500 here, 616, if we are in an ensuing uptrend, 616.15 will be our firm resistance. After 616.15, we can hit 627.05. Also, not to mention, we do have a rising wedge here. If you can see, I'll get rid of my extension level so it's a little easier to see. I'll get rid of this line as well. We can see that we are currently in a formation right now. We have 1, 2, and 3 touches, and we have 1 and 2 touches here at the top. So we're kind of narrowing in. We're narrowing in the price within this range. Buyers and sellers, they are converging. And this can be a good sign if we break out to the upside, or it can be a bad sign if we break out to the downside. Again, we want to be ready as traders. We want to be ready for both sides, whether you're trading credit spreads, simple calls or puts, whatever the case may be. We have the option to adapt and go with whatever the market is giving us. We shouldn't be biased here. So it's good to take into account both sides of the equation. So adding those Fibonacci extension levels one more time from point A to point B to point C. Again, if we move higher than 616.15, there is a possibility we can break out of this wedge to the upside and see 627.05 for a good, nice, healthy market. If not, this will be our hard, firm resistance, 616.15. We do have a resistance incoming at 612.38. I don't know how strong that will be. The 78.6% level, if there is fundamental bearish sentiment, the 78.6% level can be pretty active. So we'll see what happens if we do come up and retest it, and we will go from there. So durable, so both sides of the equation. As of now, the market is making all-time highs here on SPY. On SPX, it is a little bit of a different story. Here we can see that we made a high of 61.2818, and now we have a little red candle just coming up right below it. So is this a top, right? That's the question I'm asking myself, because at the same time, QQQ, which is our Nasdaq-100, has also not gotten above the resistance at all. We will find out over the weekend and over the upcoming week if we do continue to make new all-time highs. Let's check out Nvidia. I know I've been doing a few videos on Nvidia, and we got the bounce. Wonderful, beautiful, right? We all got the bounce that we were looking for. In terms of should you buy the dip, well, that's entirely up to you, but we had this pattern 1, 2, and 3. We got the bounce, and we are filling the gap over here. On the daily chart, if we go back, we can see that we are filling this gap right here, and we have almost completed the filling of the gap. We have our gap resistance at 141.88. So that is also to keep in mind as well. Why is this important? This is important because Nvidia is one of the top 3 holdings of the S&P 500. It is about 5.75% of its assets, also along with Microsoft and Apple. So with that being said, right, if Nvidia comes down, that can also shake up the broader market as well. If Nvidia is coming up to resistance up here of 141.88, potentially a resistance, right, we can see something kind of like this, and the market might come down with it. That doesn't have to happen, but something to keep in mind if Nvidia wants to fill this gap and then not see any more further upside. Just a possibility, just something to keep in mind. Google, for anyone who watched my Google video, we were talking about how Google can potentially fill this gap down here at 176.79. Still a very possibility. It has not filled it yet. As you can see right here, we have not filled it. And also, this is a support level, which I saw right here. 1, 2, and 3. A support level at 182.49 right before you start to fill the gap. So if the price goes below this support level of 182.49, then we start to fill that gap. And Google has not done that yet. And it just leads me to believe that, hey, if Google wants to fill this gap, it can. Google can move lower as well here. And if Google moves lower, well, the broader market might also move lower, because Google is a top 10 holding of the S&P 500 as well, with 2.33% of its assets currently in there. All right, everybody. So we just went over some of the potential scenarios. Keep in mind that we can move up or down. Don't be surprised if we move down. Don't be surprised if we move up. Adapt anything can happen in today's market, and it's beautiful. It's awesome to watch it, and it's awesome and it's fascinating to trade it efficiently. When you're trading it and you're in flow and in harmony with the markets, you don't care which way it goes, because as traders, we have the opportunity to take advantage of both sides, and that is one of the most beautiful things that we can do. So thank you for watching. If you liked the video, feel free to leave a thumbs up, subscribe for more, and let's get to it, everybody. Happy trading. Do your own due diligence. None of this is advice, and I wish you the best in your trading endeavors. Take care.